Coming to you from full global headquarters in Alexandria, Virginia. I'm Chris Hill. I'm here with senior analyst Ron Gross, and I'm Emily Flippen. Thanks for being here.
Hey,
always a pleasure, Chris.
Yankees versus Red Sox, Celtics versus Lakers, Patriots versus everybody. The great battles of our time, and in the investing world, it is growth versus value. Two very
That's a little bit extreme.
different
but okay.
approaches to investing. We're going to dig into both of those. We're going to be taking your questions. Let's start with this, Ron. Value investing, I think that's one of those terms that a lot of people are familiar with, even if they're not familiar with what goes into value investing.
Sure. So traditional value investing is trying to find what typically is a solid company, a strong company that is undervalued based on a series of different metrics that we can get into. And that will provide the investor with a market-beating rate of return from today's price where you are theoretically purchasing the company. Now, deep value investing, contrasted with traditional, is also known as cigar butt investing. And that's where you're typically looking at a troubled company or a company that's not so great, that is also undervalued, but only has one good puff left in it. And that can be dicey because if we call it wrong, that company probably is going to zero. So I think for the most part, we should stick with traditional value investing.
All right, we'll stick to traditional value investing. But first, Emily, how do you think about growth investing?
Virtually the opposite of what Ron just described. What you're trying to do is you're trying to find the fresh cigar, let's say. It's companies that have typically either had really great momentum in the past, so a lot of people associate growth investing with momentum investing. Companies that have appreciated significantly tend to continue to appreciate. But when we think about growth investing, it's usually associated with smaller companies, companies that have a lot of room to grow, and typically that's reflected in their revenue growth rate.
Yeah, I was going to say, I think the main difference to me when I think of value and growth is the amount investors are willing to pay today for future earnings growth that may or may not materialize. And traditional value investors don't like to pay up that much for a future that is by definition unknown. Growth investors feel a little bit more comfortable paying up for what they see as a significant growth opportunity into the future.
Well, Emily, let's get into some of the metrics for both here. What are a couple of key metrics that investors should look for when it comes to growth investing?
Unlike value investing, which has traditionally been much more focused on metrics, growth investing is harder to kind of analyze on a metric basis simply because, like Ron mentioned, you're trying to predict out what earnings could be in the future. And a lot of these companies are unprofitable. So a lot of people will look at metrics like price to sales. A recent metric, which has been really popular, I'd probably say over the past year or so, it's kind of made a resurgence, is something called the Rule of 40, which is to say that the company's revenue growth rate in combination with their net profit margin should add up to 40 or greater. So if you have a company that says it's growing 80%, but it has negative 20% profit margins, that 60 total meets the Rule of 40. But if it's less than 40, then it's a company that maybe isn't growing fast enough to justify today's current margins.
Ron, in terms of value investing, I'm assuming one of the, probably the best known metric is one to look at, price to earnings.
Best known, but perhaps not the best one. Value investors are typically focused on cash flow, or specifically free cash flow. So metrics that kind of get at that would be the most ideal. So price to free cash flow, enterprise value to EBITDA, earnings before interest, taxes, depreciation, and amortization. If you're going to be focused more a little on earnings than cash flow, then price to earnings is fine. It's a little bit of a quick and dirty metric that kind of leaves out some key important things and can sometimes be misleading, but lots of folks use it. We even talk about it a lot in venues like this because it's easy to understand and it's quick.
Is one of these approaches better than the other, or is it all situational? Is this one of those times where, depending on where you are in your investing life, depending on your age, depending on your risk tolerance, one might be better than the other, or is there a general rule of thumb? Because on the surface, it really does seem, Ron, like one of those approaches is going to be better as you get older.
So there are several studies that I could point to that show that value outperforms growth over a long period of time. Now, anyone who's been investing over the last decade will not believe me, and for good reason. For sure, growth has pounded value over the last decade, led by FANG stocks, tech stocks, and it hasn't really been that much fun to be a value investor. But again, over the long periods of time, studies do show that it outperforms, and I think that we'll come back to that at some point again. But I think it's perfectly fine to have a balance in your portfolio. I'm probably 80% conservatively positioned with value type stocks, mature companies, but I also probably own about 20% of high tech, biotech, in my portfolio as well, because there are certain industries that I just want to participate in. And at the Fool, we really typically focus on companies more than we do so stocks. We try to find great companies that we want to be owners in.
What do you think, Emily?
I'm going to be bold and say that I think growth is probably better to be invested in. And that's easy for me to say because I'm young and I have a long time horizon. And I think if you're getting older,
What are you saying?
I'm just saying if you're nearing retirement age, if you plan on needing assets at some point over the next 5 to 10 years immediately, then you should probably not be as heavily invested in growth companies. You should be in safer investments, maybe not less in the market in general. But I do think that when you look over the course, not just over the past decade, over the course of my life. So since 1994, if you look at the performance of value versus growth, the only time that value stocks have outperformed growth was during the Great Recession. We shouldn't see periods of 20, 30, 40 years in which growth outperforms value if value is a legitimate investing practice on its own. I think there's going to be periods in which value outperforms growth, but there's a reason why macro-based hedge funds have performed so poorly as they have, because you can't predict when the economy is going to turn. So when push comes to shove, I would much rather be invested in growth companies and weather a long storm, whether that be the Great Recession like we saw in 2008, 2009, whether that be the 2001 tech bubble burst. I'd rather weather those storms and get out higher on the end than try to predict when those storms are going to happen and move all of my stocks into value stocks only to be worse off for it.
Well, and we've talked some about metrics, but Ron, experienced investors know that a lot of this comes down to emotion, what I like to call the sleep factor, and there can absolutely be older people who have a greater risk tolerance and they're going to be more interested in growth stocks, and on the flip side, there could be younger people who say, you know what? I just don't want to lose my money. We actually, the Motley Fool just ran a poll on Twitter recently about sort of like, what is your number one goal as an investor? And beating the market, which is something that we like to look at and measure ourselves again, actually didn't come out on top. It was simply making money. And that was something I thought of when we were getting ready for this event today, where I just thought, yeah, I could see that for a lot of people. They just don't want to lose money. And so a value-based approach is probably going to be better for them.
Yeah, value investors typically define risk as the potential for a permanent loss of capital, and that speaks to what you were saying. Warren Buffett's rule number 1 is don't lose money. Rule number 2 is look at rule number 1. But most folks also think of risk as volatility, which is the movement in stock prices. And that's why some folks should just not own biotech stocks, because they can jump 10, 20% in any given day. Now, that doesn't equate to risk in my mind, because it doesn't necessarily tell you what's going to happen ultimately with the company, with that stock. It's just intraday, intra-week movements in stock prices. But a lot of folks don't like that movement.
And a study showed that investors feel the pain of losses much more than they feel the I guess, happiness associated with gain. So I understand that the poll would probably say that, hey, I just don't want to lose money because I feel that a lot more. I will say that there are lots of opportunities within value and growth where there's overlap between the two. I think some growth companies can actually be great value plays. That's kind of the idea of investing, is that with some idea of expected growth in the future, there should be a value today at which something is worth. So we can agree on that premise. I think the way that value has been posed historically, it's actually based off things that are outdated now, like price to book value. Book value is something that I don't think any of us spend tons of time here thinking about, at least not for a lot of the companies that we're invested in. So I think the idea that there's a difference between value and growth is kind of outdated within itself. I think we need to redefine what is value and what is growth.
Yeah, and I think it's important to note that even value investors are owning companies that are typically growing. You're not typically buying a company that is contracting. That wouldn't make much sense unless it was like one of those deep value cigar butt opportunities. So there's always growth. It's just a matter of how much growth and how much are you willing to pay for that today.
All right, we're going to get to your questions in just a couple of minutes, so keep those questions coming. Also, if you give us a thumbs up on the video, it helps other people find the video that we're doing. If you like what we're doing, we appreciate it. Before we get to the stocks, because I know you both have a stock to share for anyone looking to build a watch list. Ron, let me start with you. Just how can people, when it comes to value investing, differentiate between the conundrum, is this a value play or a value trap? Because we've seen well-known companies, certainly this week, we've seen two retailers that are known to a lot of people, Macy's and Kohl's, come out with earnings report. The stocks are down. These are businesses that people are familiar with. The stocks are selling off. And I'm sure there are some people who look at that and say, well, maybe it's a buying opportunity. Maybe it's a value play. On the flip side, it could be a value trap. What are one or two things you look at when you're trying to figure out whether it's a trap or an actual value play?
So I think if you buy a good company, a strong company, even if you don't pay exactly the best price, you're likely to make money over time. You might not beat the market, but as some folks, as you just mentioned, that's not really necessarily their main goal, although theoretically it should be, because otherwise you could just buy a passive index like the S&P 500. But if you buy a strong company, even if not the perfect price, you'll probably be fine. If you buy a company in the hopes of a turnaround or some kind of a fix or a management change, something's not right with this company. If that doesn't change or if that doesn't turn, that could be a trap, and you could actually lose money, not just make less than the market as a whole.
Emily, let me ask you a similar question, although the growth stock version of the question. How do you decide whether a stock that's on the rise, that gets labeled as a growth stock, it's unprofitable? What are you looking at to determine, okay, this is something where I think that at some point they're going to be able to pull the profit lever, or this is a business that's just losing money hand over fist? It's being bid up in price because people think there is a pot of gold at the end of the rainbow, but I don't think there is. How do you figure that out?
It's actually similar to what Ron mentioned. So fundamentals matter more than valuation. You'll actually see a lot of growth investors looking at stuff like PE ratio for really, really fast growing companies, or forward price to sale ratio for really fast growing companies. And it's not necessarily the best way to look at them, because you have to look at the underlying business. You have to understand the unit metrics of that business to see if profitability is on the horizon for them. And I think one of the best examples on the public markets today is probably Uber. Uber is an uber growth company. I don't think anyone could say that it's not a growth company, but the metrics as they stand today on a unit basis, the unit metrics simply aren't there for the company, and profitability, at least over the short-term horizon, isn't there for them. Now, I have been a staunch sayer in the fact that I think Uber has more pricing power than they're expressing right now, but given the fact that they haven't started to move their numbers in that direction, you can simply watch the trends of these companies. They evolve, and understand the unit metrics kind of makes you realize, hey, this is a growth company and they're growing revenues really quickly, but the market's not going to value them on a price to sale basis forever. You need to have some earnings, some shareholder return at some point, and Uber just isn't there yet, unfortunately.
All right, if you're building a watch list of stocks, they're going to give you 2. You can get 5 more in a free report we've got. You can go to fool.com/YT. For YouTube, yes, we did think this one through. Fool.com/YT. Get a free report, 5 stocks for the next gen revolution. Emily, let me start with you. For someone building a watch list, what is a growth stock they can put on their watch list?
So this is a growth company. It's called Bilibili. The ticker is BILI. It's a Chinese internet streaming company. They're often called the YouTube of China, although there are lots of YouTubes of China, so it's not a one-to-one comparison. But it's a really exciting growth company, in my opinion, because it's focused at a very niche audience. Is Generation Z in China, and Chinese companies have been beaten down so horribly. I know that if this was a US-based company, in terms of valuation, we'd see a much higher price tag on the company than we see today. But for somebody who does have a long-term time horizon, does have the ability to handle the volatility that inevitably comes with investing in Chinese companies right now, Bilibili is a really exciting company. They just reported last quarter, or a few days ago, they reported their quarterly earnings. They had 72% year-over-year growth rate, negative 22% net income margin. So it does pass that rule of 40. Admittedly, for them, right now, the focus is on just getting paying subscribers. So their margins have increased substantially as they've converted just free users to paying subscribers. You have to take a special test, and they're very selective about the way that they allow you to be a member of the community, and I really like that aspect of the business. So without dragging on too much, I think it's an exciting company. I think it's going to be extremely volatile, especially given the fact that it's in China, but it is a growing company trading at actually a pretty reasonable valuation today.
All right, Ron, a value stock for anyone looking to build a watch list?
So, following a 10-year bull market, it's tough to find value investments, no lie. I'll hit you one quick. That's one of those good, solid companies that won't be in a trap, which is Berkshire Hathaway. Relatively obvious, BRKB. $128 billion of cash to deploy. I think we'll mostly see them end up buying their own stock back. It is an insurance company, so I will talk book value just as one time, only 1.3 times book value. I think Berkshire is a good stock right here. Now, a little bit more interesting, one with a little bit more hair on it is Dave & Buster's, ticker symbol PLAY. It's a restaurant and arcade company, 133 locations. The stock got crushed in June and then a bit again in September after a weak earnings report, 2 week earnings reports. Shares are actually down 9% on the year, and as we all know, this is a very strong stock market year, so significant underperformance. Investors are rightly focused on negative comp sales, lowered guidance, but results, in my opinion, are actually not that bad. Total revenues for the latest quarter up 7%, earnings per share up 7%, number of stores increased 11. But again, the big problem, comp sales are falling. You don't want to see that. You have to see that reverse. They are returning capital to shareholders. They repurchased 3.4 million shares recently. They increased their dividend by 7%. You get a 1.6% yield at that new rate. Not too shabby. So now what are they doing? They're taking steps to improve results. They're remodeling stores. They're cutting costs. They're on track to open another 15 stores in fiscal 2019. New initiatives are going to take time. But at 12.5 times earnings, a PE ratio of 12.5 times, I can be patient there. That's a pretty cheap valuation, assuming that they turn things and this doesn't become a trap. Keep an eye on the balance sheet, a fair amount of debt, but if they fix the problems, I think we have 40 to 50% upside here.
And it doesn't show up on the balance sheet, but I will say that the popcorn chicken at Dave & Buster's is addictively
Delicious.
tasty. Let's get to the questions that are coming in from the folks who are watching. Ronnie asks, I've heard the phrase falling knife thrown around with value investing. What exactly does that mean?
It's all investing, but when a stock is plummeting, you got to be careful not to catch a falling knife. Sometimes a falling stock is a great opportunity to buy a company cheaper than it was trading at the day before. Sometimes it's an indication of real problems. You got to do the work. You got to do the research to figure it out.
RJM asks, for you, Emily, what do you think of Uber as a great growth stock for the next 5, 10, even 15 years? I think based on your earlier comments, you're maybe not ready to put it in the great growth stock category just yet.
There are growth stocks that I like better, and there are a lot of reasons to dislike Uber, especially at today's prices. I do think there's probably more downside left in Uber. There's a lot of legal battles that are fighting against it right now, but I've said it before, and I think David here at The Fool David Gardner, calls it the snap test, which is if you were to snap your fingers and make a company disappear, would you notice? And I've never met a company that has passed the snap test as well as Uber passes the snap test. Now, granted, we have Lyft, right? But the thing about Lyft is it doesn't have the scale that Uber has, and you would definitely notice an increase in prices if Uber were to suddenly go away and Lyft can essentially charge whatever they want to. So I think the fact that we're kind of an oligopoly right now, they're still working out the pricing, so we're really seeing an unprofitable company right now that really has no plans to be profitable. I'd say wait for the time being. I do think there's potential for Uber and Lyft, both of them, to have a bit more pricing power, hopefully turn themselves into profitability, but right now they're just not there, although I don't want to completely hate on them because I do think that there's an opportunity there. We're just not there yet.
Dwayne and James both asking about Shopify. What are your thoughts on Shopify? Is this a good growth stock?
Yes, it's a great growth stock. It has proven itself over the past year or two as being one of our best growth stocks. I'm actually going through the process of reevaluating the stocks that we have in Blast Off 2019. That is one of those companies. And the question we're asking ourselves is, do you think Shopify has the same growth potential today that it did a year ago? And I don't have a full answer for you yet, but I will say that I feel confident in the business model that Shopify has. And the fact that we are seeing third-party sellers leave platforms like Amazon. Nike recently was a brand that got big enough, they don't need Amazon, right? Their trial with them ended and they're directing people to their own platforms. And I think as brands develop and as Shopify continues to integrate their processes in such a way that you as a consumer notice no difference in ordering something on a Shopify platform versus ordering on Amazon, that's a big opportunity for them. And I think when you look at a company that's grown as much as Shopify has, it's easy for us to say that it's impossible for it to 10x, right? But the fact is that if they've proven themselves and they've proven the value of the platform, there's no reason why they can't. And so I tend to lean towards that actually being a great growth company. It's proven itself as such thus far.
Yeah, that's one of those companies that even this value investor would add to. I don't own that one specifically, but I would.
Lori asked, when you have limited money sitting around, is it better to buy one stock or small numbers of shares of multiple stocks than potentially adding to positions down the road? Certainly, it's cheaper to buy multiple stocks with Schwab and Ameritrade and pretty much every online broker cutting commissions to zero.
For sure, it's great for the consumer, for the investor. I like to see all portfolios be somewhat diversified. I'm a big fan of buying an index fund, perhaps as your first investment, so you get instantly diversified across 500 companies. For example, if you buy an S&P 500 ETF, then you can just start to buy your next company, your next company, your next company, or you can take little nibbles in several. I personally, it doesn't matter to me. What matters to me the most is getting your capital invested as early as you can and sticking with it consistently.
JL asks, do you have any interesting growth stocks with exposure to the cloud?
We have a ton around here. Are you?
It's going to be impossible to find a growth company that's really hot in the market today that doesn't have some form of cloud exposure. I think what's important to look at when you're looking at cloud-based companies is looking at cloud-native companies. So a company that we really like here at the Motley Fool is Datadog. It's a relatively recent recommendation. They have a cloud-native platform, and while there's lots of competition in this space, I mean, New Relic is obviously another company that's really strong. And I mean, it's a legacy system, but they've also made a great name for themselves. Datadog continues to prove that the value that's associated with having a cloud-native platform, especially as it goes to growth companies, is extremely important. When we look back and we look at the performance of growth companies versus value companies, part of the reason why growth stocks have performed so well is because they've been quick to take up new technologies. And the importance of cloud, as we're seeing with the developments that we see today, I mean, with Google and gaming and cloud-based gaming, for instance, it seems like everything is moving to the cloud. So I think it's important for any growth company you have to realize how they are building or not building off of the cloud environment.
Amazon and Microsoft, two of the biggest players in the cloud, great stocks to own. Some lesser known stocks, maybe Salesforce.com, Zendesk, HubSpot, lots of great companies. These companies have had quite a run. They've had their pullback, they've had their run, not necessarily for the faint of heart from a valuation perspective, but really great companies.
Cross asks, can you talk a little bit about the famous margin of safety idea? How exactly do you measure it?
Okay, so the margin of safety is you have a stock price today, you have an opinion of what the stock is actually worth. The difference between those two things is the margin of safety. If you take it on a percentage term, it's the stock price, what you think it's worth, minus the stock price today, divided by what you think it's worth. That's margin of safety on a percentage basis. And it's kind of an indication of if you're wrong, how much safety do you have? How much leeway do you have in there? It also, when you look at it from the other way, it's your upside potential as well.
By the way, whether you're looking at value stocks or growth stocks, what if I'm wrong is a great question to ask in any situation. Because essentially when we're buying a stock, we're buying it because we're expecting it to go up. Probably worth taking a couple of minutes and saying, wait a minute, what if this goes sideways?
And position sizing can come into play there too, because if the future is truly unknown, but you still want to take a chance, you can do so, but keep it to a small allocation in your portfolio.
Anur asks, are there growth stocks that pay good dividends? Should growth companies be paying dividends?
Oh, I was ready for this one, Chris. Okay,
limbering up.
I'll sit back and let you get comfortable.
I talked about this company on live streams before, I believe. I talk about this company a lot because I work on a marijuana service here. But a lot of people are interested in Canopy Growth, which is one of the largest Canadian cannabis companies. And the way the cannabis companies have traded so volatile. I mean, we saw the huge pulls back last week. Today, they're up on U.S. potential, U.S. approval in the House of Representatives, at least. So Canopy Growth has exposure through a great dividend-paying company called Constellation Brands. They're a wine, liquor, beer company. They pay a steady dividend. It's a relatively low yield and has great growth associated with their exposure to Canopy Growth. Now, that has dragged their stock price down. The underlying business has actually been pretty okay for them in terms of their alcohol business, their beer business especially, but the Canopy Growth business has dragged them down. But I think that's a great company in the sense that you have a stable underlying business with exposure to the upside of the cannabis industry. So that's a great way to get exposure. It pays a steady dividend. I think the reason why you don't see more growth companies paying dividends is because they simply don't have capital. If they're a growth company, what they're doing is reinvesting in their own growth. That's how they continue to grow. If they're giving dividends back to shareholders, they simply can't do that.
And as an investor, if you own a high growth company, you theoretically don't want them to pay a dividend. As long as they have reinvestment opportunities within their company, you want them to put that company to work within the business. As companies get more mature and the growth opportunities aren't as significant, that's typically when you start to see companies pay dividends. But those companies are still growing. The dividend aristocrats of the S&P 500 are huge companies that still have growth potential, but they also have enough money to pay a dividend.
One commenter asks, what do you do when a stock you own has gone on a crazy run like Shopify? Do you buy more or do you sell? It's a good problem to have when you have a stock that has gone on a great run.
I think there's a medium there. I think hold's an option. I definitely don't like to sell companies that are on great runs. Typically, the company that increases 100% is the one that's most likely to continue to increase. So I think if you're trying to time the top for companies, whether that ends up being the top for Shopify or just, half of what it ends up growing into 3 years from now, who knows? But the idea that you'd suddenly sell something just because it's appreciated, I think is a little bit misguided.
That's one of the reasons I like value investing, because it helps me determine under certain circumstances what I think a company could be worth. And if the company reaches that level, then perhaps the return potential going forward isn't as strong as it once was, and I would either sell the stock or pare it back, understanding that valuation techniques are inherently wrong and can be misleading. So you've got to be a bit careful there.
Carl asks, why are stock splits so out of favor? I have that question as well, because there was a good stretch of time where stock splits were very much in favor. They were exciting, even though it doesn't change the underlying value of the company or your stock. But let's face it, more shares are fun. It's just more fun to have more shares, Ron.
Okay, that's fair. But as you said, it doesn't do anything except increase liquidity. Most of these companies are plenty liquid enough. They don't need to do that. And in the age where you can actually buy fractional shares more and more, it doesn't necessarily matter if a company is trading at $1,000 per share, because you can still participate.
Linus asks, it seems like all growth stocks have been pointing to huge total addressable markets to justify their valuations. How do you separate the wheat from the chaff?
Yeah, how?
It's a great question, Linus, so thank you for that. He's absolutely right, Emily. It seems like every growth company, particularly the unprofitable ones, on their quarterly calls are coming out and saying, boy, look at this industry we're in, look at the markets we're expanding into. Once we hit the profit levels, oh, this is going to be amazing.
I love this question because I actually have a little test I do. If I hear any management say, we think our industry is a $50 billion industry, and if we get just 10% of that, we'll be a $5 billion, it's an immediate no from me, Chris. Because what that says is that you're depending on reaching a large market, and you have no strategy for doing such other than the idea that a rising tide will lift your boat. Now, trust me, you need to build a good boat for that to be the case. Your boat needs to have giant holes in it. And so that's an immediate cutoff for me, is that if somebody's only pointing to a large market and has no clear strategy to get there, it's a no. So otherwise, then trying to, apart from them just coming out and saying that, and trust me, companies have said that before, what you would do is just look at that clear strategy, figure out how they're going to tap into that market, and ask yourself, do I actually believe what management projects to be their total size? Because some companies will go out with crazy sizes. There'll be, a cloud-based security solutions company that has 3 customers in California, and they'll be like, the entire worldwide internet economy is, I love that, the economy of stuff. So there's lots of ways that they can define their addressable market. Be sure that's something that makes sense to you, and just do a little bit of your own research on the side.
Lori asks, Emily, do you still like Zynga?
I do still like Zynga, and we're actually having a conversation today about our members and what stocks they favorited. And Zynga is one of the most favorited stocks that we have right now. And I actually think that's because the share price is so low. And I think it's because people feel like it's a value company, or it's a company that's accessible to them. I think it's a company that we talked about a little bit when Ron and I came on YouTube Live. We talked about cheap stocks. Zynga to me is a really interesting turnaround story. People associate it with the old school Farmville games on Facebook, and they've actually done a really great job of reinvigorating their lineup with new mobile games. I think mobile gaming is probably going to be a really big industry in the future, and I think Zynga is actually really competitively positioned. So yeah, I'm still a fan.
Last question for you, Ron. Lakira asks, would you recommend investing now or waiting to start investing until next year? It's entirely possible. Lakira is thinking back to the end of 2018, where December was a brutal month.
Yeah, my answer will always be now. Always invest now, don't wait. Hopefully you're a consistent investor that will put money into the market over long periods of time, regularly. You'll buy when things are high, you'll buy when things are low, but you'll keep buying, and in the end, you're going to be just fine over a long period of time.
All right, we're going to wrap up there. Ron Gross, Emily Flippen, thank you so much for being
thanks for
here.
having us.
Thank you so much for watching. Again, thanks for giving us a thumbs up. It really does help other people find the videos that we do. If you like what we're doing, absolutely hit the subscribe button so you don't miss anything we do here at The Motley Fool. And again, if you're looking for 5 additional stocks to be part of the next gen revolution, go to fool.com/YT and check out that free report. Thanks again for watching. I'm Chris Hill. We'll see you next time.